everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. So this technical deep dive is looking at our beloved deferred tax, mainly deferred tax in acquisitions, and why fair value adjustments create deferred tax. So I think this is probably a topic that students find quite challenging. So what I want to help you do is to understand the logic of temporary differences that are created by those fair value adjustments and not just the calculation. So based on my experience of working with SBR students, deferred tax in acquisitions is one of those things that students often calculate without really understanding what they're doing or why they're doing it. So we know that when we're doing our acquisition accounting, we increase an asset to the fair value for consolidation purposes, but then all of a sudden a deferred tax liability appears and it's like, whoa, what's going on here? And students just try and memorize the rule, okay, which can work. But the real question is, why does simply revaluing an asset create a deferred tax? And once you understand that commercial logic, this whole area will become much easier. So let's think about acquisition accounting. So when a company acquires a subsidiary, under IFRS 3, it requires the acquirer, company buying, to measure the identifiable assets and liabilities at the fair value. Okay, so this means assets often do increase in value. Okay, so let's say, for example, a building might have a carrying value of 10 million in the subsidiary's accounts. They measure it at cost, but it might have a fair value of 14 million. So in the consolidated financial statements, what we're going to do is we're going to increase the asset by the 4 million, okay, taking it up to that 14. So this adjustment affects goodwill. We all know that we pop in our fair value adjustments in our goodwill calc, but it also creates a deferred tax. And the reason is all about the difference between the accounting value from an accounting perspective and those tax values. So what we know is that accounting and tax follow different rules, okay? Accounting rules, they come from IFRS or whatever gap we're looking at, but for this exam, IFRS. And tax rules come from the tax authority, okay? Usually HMRC in the UK. And the tax authority does not automatically change asset values just because the group prepares consolidated accounts, okay? So when we adjust assets to fair value in our consolidation, that change often exists only in the group financial statements, nowhere else. So the tax system continues to use that existing tax base. Yeah, remember, tax base is the tax carrying amount of the asset. And what that does is, because we have our accounting carrying amount and the tax system has their tax carrying amount, we have these temporary differences that arise. So let's have a look at an example step by step. So let's say before the acquisition, the subsidiary had a building. Okay, so in their own accounts, the subsidiary's own accounts, the accounting carrying value is, say, 10 million. Now, what we know is from previous just experience, the tax base, the tax authority set was 8 million because tax depreciation rules are different. Okay, so we've got an accounting carrying value of 10 mil, tax base of 8 mil, that creates a temporary difference of 2 million. Okay. Now, the subsidiary may have already recognised deferred tax on that difference that they've got. Yeah. However, now the group acquires that company, and IFRS requires the building is measured at fair value, which is 14 million. Yeah. So on consolidation, we're going to increase that building from 10 to 14. However, the tax authorities still see the asset based on the tax records, and that tax base based on those tax records is 8 million. So the tax authority doesn't change the tax value just because we prepared a set of consolidated accounts. So what we have now is we have a carrying amount in the group accounts of 14, the fair value, and a tax base of 8. So now we have got a group temporary difference of 6 million. So that difference means that in the future, the group will effectively pay more tax. Yeah. But why? Okay. And the why is because the accounts recognise the asset at a higher value, but the tax system still uses that lower tax base. So when that asset is sold or depreciated, the taxable profits will be higher than the accounting profits. Yeah. And deferred tax recognises that future tax consequence today. Now, notice something important here. Before the acquisition, the difference was only 2 million. After the fair value adjustment in the group accounts, the difference becomes 6 million. So that fair value uplift created an additional temporary difference of 4 million. And that additional difference is what creates the deferred tax in that acquisition calculation. So why does this all matter for goodwill? All right, so remember, deferred tax is recognised as liability in this instance. That means it reduces the net assets of the subsidiary. Yeah, and because goodwill is calculated using net assets, this affects the goodwill overall. And students do often forget this. Yeah, the fair value uplift increases net assets, but the deferred tax partially offsets that increase. Yeah, so that final effect flows through that goodwill calculation. So hopefully a very simple way to remember this is if our fair value moves and the tax base stays the same, that gap creates a temporary difference, and that temporary difference creates the deferred tax. So in the exam, the examiner isn't just looking for the number. Okay, you might get 1 or 2 marks, but it's not just looking for the number. What they want to see is that you understand why the deferred tax exists. So what you want to do is you want to explain that the asset is increased to fair value and consolidation, and then explain that the tax base remains unchanged. And then you can go on to explain that that difference creates future taxable amounts. And that is the explanation where a lot of the marks do come from. Thanks for watching. Hopefully that made the logic behind that standard just a little bit clearer for you. If you found it useful, subscribe for more short SBR Technical Deep Dives. I do post new ones every week. And if you're struggling for SBR and do want support turning that technical knowledge into exam marks, you can find details of my mentoring in the description below. See you on the next one.